Hello, all the great Apex clients. Hope you're having a great week. Welcome to your quarterly update for the September quarter of 2025. Over the next 5 or 10 minutes, I'll run you through the prism of a slight change, the BetaShares All Growth Fund, and how that's relating to the macroeconomic climate and global share markets, as well as a bit of a product spotlight around investment bonds. So let's jump in. Again, September saw a very strong and positive quarter for global markets. Interestingly, the Trump tariff outlook has dampened the outlook for global growth somewhat. And locally, particularly with the healthcare sector on the local bourse, which is the third biggest sector on our bourse behind mining and financials, it's trading close to a 52-week low. And he's down 18% this year, with CSL being the worst performing large cap on the entire bourse. And other healthcare stocks have also struggled throughout. This is because of somewhat of tariffs, but also because of dampened performance and poor performance. What we have seen, though, is the global economy is and has proven to be very resilient amongst all the uncertainty. So last quarter, we spoke about being comfortable, being uncomfortable, and lots of uncertainty still remaining with tariff fears, weak US and Australian job growth, and poor data out of China. But the resilience of the global economy is shown in the first half of this year in the face of this significant uncertainty, mainly related to tariffs as well as geopolitical issues. And as such, that's been somewhat surprising. Interestingly, from a support to markets perspective, 60% of the world's central banks have cut their policy cash rate 3 times to July. And that has provided extra liquidity, which helps to explain the resilience in the market. So the lower interest rates has helped markets remain positive. Now, as I alluded to in our prelude, we're now taking a look at the 3-monthly return to 30 September 25 through the BetaShares All Growth Fund. Normally, we look at the Vanguard High Growth Fund, but we are changing this to the BetaShares All Growth Fund. The Vanguard High Growth Fund is a 90% growth, so businesses, shares, property, 10% defensive. BetaShares All Growth Fund is 100% growth, and therefore it's a slightly better representation of global markets. Again, same story. If you connect with what's owned in here, it's things like Microsoft, Apple, Visa, PayPal, so on and so forth, and Combank, Coles, that sort of stuff on our market. And we're sitting at a 5, just shy of 6% for the September quarter. So nothing to be sneezed at. And this is a very good proxy again for global markets, with 100% allocated to stocks and businesses. Very good over there. Now, this is a graph from some research to 31 December that I made, and there's a great quote from Warren Buffett's mentor, Benjamin Graham. So I'm not sure if you would have heard of those Ben Graham before. The investor's chief problem and even his worst enemy is likely to be himself. So what does this data tell us? It's Morningstar's recent research that agrees with Ben's quote. Over the past decade, US share funds, so the S&P 500 has produced a tick over 8.5%, yet the average investor's only earned 7.3%. That is 1.2% year on year missing, and it's not about fees or access. It was lost due to poor timing and emotional decisions. The hardest part of investing isn't picking the fund, it's managing behavior. Getting out of your own way is very difficult. And this data packs things up. So it's the SPIVA scorecard, which stands for Standard & Poor's Index versus Active. You would have heard me banging on about index versus active investing. And this helps give us a scorecard between the two common styles, showing us that, again, over long periods of time, underperformance remains with active fund management after fees and taxes are counted in. Over the global equity area, we're seeing in the 90% range over 15 years. Sorry, 76%. So over 15 years, which is this one here, my apologies, 90 in the mid 90% range of underperformance, which is interesting to note. And another interesting graph that I've noted this quarter is with stronger earnings growth and less exposure to the suffering blue chip and materials, Australia's small and mid cap have begun, so smaller companies outside those really big mining and banks have started doing very well outperforming after the recent reporting season. With the prospect of further rate cuts in the market environment, could be ripe for a rotation to smaller mid caps to continue. Which you would have heard me banging on, that research shows that out of index and active investing, there's no doubt in our minds that index investing is the approach to take for long-term investors. And what really helps drive long-term returns, amongst other things, is asset allocation. How much sits in Aussie, US, so on and so forth. And then you can actually get more granular from there. So in US, you can go large cap, small cap. In Aussie, you can go large business, smaller businesses in terms of their market size. And as such, this graphic is just showing us that you can get more granular with your asset allocation, and that those smaller to mid caps are starting to underperform, which a lot of you out there have exposure to through the portfolios we manage and maintain. Now, a bit of a product spotlight around investment bonds. This is particularly interesting to note. They're a financial product we often use at Apex Advice for the reasons outlined on the screen here. So they're very tax efficient. If you're a high marginal tax rate person, so anywhere 30 to 47%, we can see an internal bond rate on earnings. So think of it like a basket. In there sits assets. Those assets generating income. A tax on that income can be as low as 12 to 15%. A bit of arbitrage there compared with your marginal rate. They operate in a very stable regulatory environment. So we know super is getting poked and prodded at by politicians regularly, which can sometimes be frustrating. It's not something the investment bond environment has had exposure to or is expected to be poked and prodded at. However, it's a very good product for asset protection purposes. So if you're a company director with risk attached to that, it's a smart move to consider protecting your asset, your risk, and protecting yourself through investment bonds. They're also capital gains tax-free after a certain amount of time, and also transferring between parties and investment rebalances. They operate capital gains free. It's also a non-estate asset, so it sits outside of your will and estate, and it's a product that provides considerable flexibility from passing on assets to the next generations. And then within the investment bond platform, there's a number of investments that will suit your risk profile. Big menu. We would typically use, or common examples where we would use investment bonds are to help plan for school fees. So get down the line and you don't have to, all your wealth creation goals don't have to take a backward seat. Around child and grandchild gifting, so the inheritance piece, debt reduction strategies down the line, and even as a supplement to superannuation at retirement. That's it. That's your quarterly update, guys. Hope you found it helpful. If you'd like to discuss anything in here, very welcome to reach out to your advisor. Have a great quarter ahead. Bye.